what different investments actually exist. So all those different asset breakdowns that we went over in the investment profiles, we're going to break down the details of each asset class right now. The first one we want to cover is stocks or equities, also known as equities. So stocks are simply just a representation of ownership in a company. It is not actual ownership in a company. You own shares of the company. The reason why this is important to distinguish the difference is because ownership in a company, you own the building that the company owns. You own the assets that the company owns as part owner. When you own shares of the company, you have a right to a part of the profits in the form of dividends and the gain in the stock, but you don't own part of the company. So stock is the representation of the value of a company, and dividends you receive as a thank you of owning the shares of stock. So dividends represent the revenue of the company that is passed back to the shareholders. They pay dividends to give back to the shareholders. So a company can do one of two things. They can pay out their earnings in the form of dividends to the shareholders, or they can reinvest those earnings in the company to go expand the business or spend it on advertising or whatever. But you as a stockholder own a representation of value of the company. If the company does well, you as a shareholder do well. That's why stocks are used for growth. There are many different types of equities. So there are preferred stocks, international stocks, meaning outside of the US, domestic stocks, meaning in the US. There's large cap stocks, meaning big companies. There's mid cap stocks, small cap stocks, micro cap stocks. So stocks are categorized based on their geographic area. Stocks are categorized based on their size. Stocks are categorized also based on what type of investment they are. So growth stocks that don't pay a dividend are considered growth because those companies take their earnings and reinvest back in the company. Value stocks, also known as stocks that mostly are out of the growth phase, they really pay most of their earnings out in the form of dividends, they move different from growth stocks. So you'll hear stocks categorized as growth versus value. Value meaning they're outside of that growth phase and they're just reinvesting in their shareholders, not in the company, in growing the company. So you will hear stocks categorized in many different ways. Preferred stocks mean that they are paying a fixed dividend from the time they're issued. So when a preferred stock is issued, they are paying a fixed dividend that doesn't go up and doesn't go down. And preferred stocks get paid before common stocks get paid. So common stocks are just the everyday stocks that you hear about on the TV. Those are the common stocks. Preferreds are something that are trade differently and they have a fixed interest rate. So they're more for the fixed income piece, but they're actually still considered equity or stock. Stocks move for several reasons. Stocks will move on good news about the company. So the value of the stock also represents the future potential of a company. So if people think that in the next year the company is going to double its sales, for example, the stock will represent that. The stock will do well. So you own stock for the growth potential. You also are at risk when you own a stock because if any bad news comes out about the company, the stock will go down because people think that the value of the company will go down. So the stock goes down. So you're at risk when you own stock within a company. You're going right along with the company in the value of the overall assets that they have. Now, with that said, stocks will also move because of the overall market. If something's going on in the economy, stocks will move just because it's a stock and people are fearful of the stock market. So if people run away from the stock market in general, like 2008, for example, stocks just go down. It doesn't mean something is fundamentally wrong with the company. It just means that's the market, that's the stock market, and people are afraid. Stocks also go down because of the overall sector they're in. So let's say, for instance, banks. We call them financials. Let's say one bank reports awful earnings. Other bank stocks might be affected because they think, oh my goodness, if this bank did bad, maybe this bank will do bad. So stocks will also go down and go up because of news about other companies within their sector. A sector is a piece of the overall market. So a piece of the overall market in this example was financials. Another sector might be energy. Another sector might be technology. These are all examples of sectors in the market.